This conference will now be
All right, how
recorded.
is everyone? Again, sorry about that. I should always do a sound check before I begin. And I'm glad to see that we have a few of you here tonight. I didn't expect any actually on a Saturday. But, being in Florida and all, I don't know whether I'll be out of commission or not come next week. It seems that we're going to dodge the bullet here, that uh, the storm is veering off course. We're going to avoid it. We're probably going to get a lot of showers and stuff, but we're certainly not going to take a direct hit, fingers crossed. Um, but I don't know what's going to happen down here in Florida, especially near the water. The moment a bird chirps, we lose power. That's how fragile things are. So that's why I was tempted. Actually, I made some travel arrangements to get out of town for a couple of days so that I'm not out of touch. And because I believe there's going to be some interesting opportunities in the next couple of weeks that I'd like not to miss out on. Anyways, I'm going to talk a little bit about what I see because I've combed through all the charts and I'm more convinced than ever that there's still another leg down. And it never ceases to amaze me every time I see a guy on CNBC who's had time to wake up, shave, and put on a suit to come out and make a call that a bottom is in. Well, why the hell is a bottom in here? Because now China and the US are back talking again about the possibility of a deal. I mean, this is not a conversational class. The market isn't supposed to rally on hopes that something is going to happen because they're talking. The market wants them. I heard that guy, I forgot his name, who always shows up on CNBC. The market just want them to keep talking. So they keep talking, the market goes up. It's not a conversational class. It's not a spelling bee contest. The market needs results, tangible results. So anyways, I'm more convinced than ever that the bottom is not in. I'm going to provide some historical context comparing this to what happened back in 2011. But the best way to characterize this is as a as a combination. We started out with a zigzag, actually a double zigzag. We started out with the zigzag. And once that zigzag was in place, we got a flat. Okay, another ABC. And funny, I'm going to call that a zigzag. That was an overreaction here. So another ABC to the downside. And I remember that this unexpected rally that drove Apple up to 210 within 2 minutes before it came back down to 200 or 199 the very next day. That was spurred by that release. They put something out to the effect that, hey, phones or whatever electronics would be spared the tariffs or will be deferred until later on in December. They'll be spared the tariffs imposed on September 1st, which is tomorrow. And that was the overreaction. Then we came back down here, came back up here, came back down here, and now, and as of last week actually, we got this zigzag. This was, of course, the result of what China and the US strong-arming each other. The president ordered companies to do what? To start looking for alternatives to China. China started talking about imposing tariffs in retaliation, and then they softened the tone this week. The president didn't put out many market unfriendly tweets, and then China was a little bit, they spoke with a conciliatory tone. They said they're not going to retaliate, and they urged the U.S. not to impose the tariffs, so on and so forth. So we got another ABC to what? Back to the top of the range. And notice how the 50-day moving average had turned red here. It's flat as can be. When it's flat, there's no trend. There's no trend. So the other thing I want to, and this is important for the future, by the way, you get a panic move like this. What do you think the retail trader is going to do? Retail traders are going to buy the heck out of puts. They're going to load up on puts. It's too late. Because the put writers, those who write the puts and sell them to whoever wants to buy them, they're not stupid. They're like your auto insurance company or your life insurance company. They're not in it to lose money. They write you an insurance so that they make money. You may never ever need it, and that's even better for them because you're making monthly payments and they don't have to dish out anything. But in the event that you do have some sort of accident, whatever, you get paid, of course, but still you probably paid into that policy more than what you're going to get back. So over the long run, you know how insurance companies work. They make money, a lot of it. The same thing, those who are writing the contracts, they're not in it to lose money. So when retail traders buy a boatload of puts and the writers are putting them out, go ahead, you're welcome, keep buying. Every time you get a move like this, it will never, at first, come down and retest. So all these puts will eventually evaporate. Their premium will erode, okay, as the time ticks on, as the clock ticks on and time decay takes a toll on the premium. So buy puts, get up here, buy calls, buy puts, buy calls, and they're all expiring unless you buy them smart enough that you buy them down here and sell them up here. Okay, but every time there's a panic selling and they buy puts near the bottom, the market swings back in the opposite direction, goes up and down the range. There's no defined trend until the market finally finds its rhythm. And when the market is complacent, when everybody's complacent, it makes that sudden move, and then they do more of this, they buy more puts, and suddenly the market reverses course. But again, ABC, and then we have this X, the intervening, or the in between the two zigzags, you have an intervening counter trend profit taker, a retest of the lows. Actually, to be honest with you, this ABC itself is an ABC X ABC, but it doesn't matter. It has the look of an ABC. So ABC, ABC, ABC. This is not the start of a reversal. This is a consolidation. They're waiting for the market to find its rhythm, to let it revert to the mean, and I'll show you in what I mean by that in a minute. And then when everybody's least expecting it, they do this. Okay? And that would be the last move, by the way. Here's what happened. First of all, I'm not a great believer in trend lines, but when a trend line proves itself worthy, I become a believer. So we failed. We've dropped below this trend line, this support line. We can call it a supply line also, or whatever, or demand line. Supply, demand, support, resistance, whatever. What used to be support is now resistance. What used to be resistance would be support at some point. You know what I'm talking about. But the important thing is to know that it is relevant because it is drawn across the two most recent notable lows. And so we got up to it here, we sold off. We got up to it right here. We printed a red candle, and you know, it's not that fatal of a candle yet, but we'll see what will happen on Tuesday. And as I said, the 50-day moving average has turned red right here. Okay, and you know, here's one thing about moving averages. They are lagging indicators. In other words, they reflect what has already happened, because they're calculated based on the previous 50 bars. However, look what happened here. The trend turned up here. When the trend turned up here in early 2019, the 50-day was still red. Okay, but we knew that it bottomed here. And then we got wave one, wave two, wave one, wave two. And then we crossed over the 50. More importantly, the black line crossed over the 50. That's the 15 EMA. This, anytime I see it approaching at a 90-degree angle almost, or about to cross over, I know that there's a change of trend. And when that crossover happens, you tend to see a reversion to it. And then you rally, you revert to it, you rally, you revert to it, maybe a little lower towards the lower Bollinger Band. Inhale, exhale, inhale, exhale, and that sometimes that exhale turns out to be something a little more than that. And you got an A and a B and a C. That was back in May. And you see here that it turned red again, but it turned red not here. Later on, when things were almost done, okay, when we got that ABC, we knew that the bottom is in. And then what happened? The 15 EMA crossed over. We crossed over the 50. We tested the 50. We rallied further. We came down, rallied, came down. And again, something more than just an easy or a normal mean reversion happened. Some sort of a reversal happened. We crossed under the 15 EMA, crossed under the 50, and then we started looking for a rhythm. We consolidated. We started to consolidate. And during that consolidation, you know what happens. You react, you become emotional. You see it go down, you buy puts, too late. You see it rally, you buy calls, too late. So on and so forth. Everybody gets whipsawed. So we are at resistance. And remember a couple of weeks ago I said, you know, I'm noticing that 5-wave pattern in momentum, and that happened right here. And sure enough, it produced a rally. We came down, tested it, lower high, actually a higher low, almost an equal low, but slightly higher, and a higher low on momentum. Now the momentum indicator, if you notice, is tracing out an A and a B and a C. And when that C wave reverts to the mean, that's what I mean by that, by mean reversion. When the momentum indicator reaches the 0 line, okay, then that's when the market is ready to turn back down, because it's reaching the 0 line upon reaching resistance, okay? And that's what normally happens. And I'm going to compare this to what I told you I was going to, what did I say earlier? I was going to compare it to what? 2011. Check this out. The correction back in 2011 started out with an A, a B, and a C. In fact, if I had shown more bars, you would have probably noticed that there was a head and shoulders. A head and shoulders. Neckline. Okay. But I didn't show all the bars here, but you can tell that there was a shoulder here, a left shoulder. So the correction began with an ABC. You know, an ABC is always a corrective, a little like a flag, like a bull flag. It's a run-of-the-mill kind of profit taker. Nobody thinks much about it. But notice what happened here. Because of the sideways movement that was going on for a while, the 50 turned red early on. And then when we crossed on, and look at the 15 crossed under right here. So that tells you there's something really bad happening. And we got back over it, and then a rubber band moved to the downside. And so, you know, it actually took me a long time until I figured out how to count this wave structure. It was an ABC, which is a W wave. That's what we call it. Followed by an A, B, and a C. That was the X wave, X. And then 1, 2, 3, 4, and a 5. That was A, the B, and the C. The C was a terminal diagonal, an ending diagonal. So ABC, X, A, B, C. In fact, when you look at it, you say, you know what, I could have bought the market right here, because this retest here, that marginal new low, was a sucker move to the downside, was a sucker move to trick everyone into believing there's more downside. Okay, when in fact, that move was an ending diagonal. And so the correction ended with a double zigzag W, X, and Y. W is a zigzag, X is a zigzag, and Y is a zigzag. But the panic was where, do you think? Right here. When it came down to retest, everybody bought puts. Stupid. The put writers sold these puts to the unsuspecting retail trader, rallied the market, came down. They sold them some more, rallied the market, came down. They probably bought a boatload of puts right here when they saw the A wave being breached. And guess what? The market turned back up to never to look back again. And in essence, it is a game. So look what happened here. The 50 was red all the way down. Then you had the crossover, the 15 EMA crossing over the 50. And sure enough, price ran up. Inhale, exhale, inhale, exhale, inhale, exhale. Came down here, 50 to 61.8% retracement, and snapped back. Impulsive move, flag, so on and so forth. But by then, guess what happened? You see that green line, the 15 EMA, the 50 EMA had already turned up, started to rise. It wasn't falling anymore. So there was a change in trend. And by the way, I remember opining on that back then. I said, look at that. The 50 turned up. The moment you drop below a rising 50, it's called a rubber band setup. The market is going to snap back to the upside. So these things are not easy because they lure you in, they trick you, they turn you. They make you very emotional. And when you're emotional, this is when you make your biggest mistakes. And you've seen me do those, of course, because I fall into these traps like everyone else, when in fact I should look more and trade less. And you see, I didn't do anything Friday at all because I wanted to learn about what's going on. Have we reached the top of the range to turn back down again? I want to know. So one thing I'd like to ask these guys that are calling the bottom. You guys have seen me talk about this ratio, the equal weighted S&P versus the weighted S&P. In fact, I was quite amazed and surprised when Bob Pisani on CNBC the other day, I think it was Friday, he was talking about what happened on Thursday, how the equal weighted outperformed the weighted S&P. But it happened for one day. Is it going to happen every day? No, because look what's been happening month over month. This is the bottom back in December. This is March. We're losing breath. Breath has gotten worse and worse. Meanwhile, the market is near the highs. That's crazy. Okay? There are no signs of a reversal here. That's stupid to even call a bottom. Maybe it's an interim bottom driven by all the headlines, by a little bit of seasonality around Labor Day weekend, even though it's there's not much of an edge as far as seasonality around Labor Day. I've noticed that there is actually over the years, but the data claims that there isn't. There's always positive seasonality I've noticed trading into, or as we approach things like Veterans Day weekend, Labor Day weekend, things that have national significance. I've noticed it always. And that's something to note also. So breadth, if you look at breadth from that perspective, it's horrible. Okay, during a healthy trend, uptrend, when the market is in a third wave, what happens? The SPX EW, which is not contaminated by the overweighted components of the benchmark index. This guy, everything is equal weighted. And this one here, as I said before, you have all these FANG style stocks or whatever that have 2 and 3% weighting. You know, Apple goes up 10%. Well, it's got a 2% weighting on the index. Guess what? It's going to lift all boats because they see that the S&P is rising and they start buying the other components, and it feeds off. These stocks start feeding off each other like that, and that's what happens when the S&P goes up and the equal weighted is not confirming. It's actually not confirming. But here it was confirming. The breadth was broad. You have the breadth. The rally had plenty of breadth in it during the early, when we came off the bottom in 2009 into 2011, 2012. That was that happened during this period here, 2011 into 2012. This is 2013 into 2015, 16. This is the 15-16 correction, and this right here is the rally into 2018. So we made new highs on the SPX in 2018, but breadth made a lower high. This was a precursor a telltale for what was about to happen in 2018. Well, things have not changed yet. They're getting worse. They're getting worse, okay? Don't tell me just because the Fed is going to cut by 50 basis points that suddenly everything is going to be great and again. Well, what happens to trade? That's what's important too. You know, I understand that cutting rates is stimulative for stocks, okay? But not having a trade deal has the opposite effect. So things have to be resolved on multiple fronts for this market to be able to get from under its own weight, okay? And maybe, just maybe, September is when everything falls in place again. We got that rate cut. There's some palpable, tangible progress, maybe a deal, because everyone is not expecting a deal. You know, all these banks, Goldman Sachs and whatever, they're all coming out and say, well, we don't see a deal until the end of 2020. China's going to wait out this administration, whatever. You know, consensus is always wrong, and we're set up, or we're being, you know, the market is setting up for a positive surprise. Who knows? We'll see. But for now, I don't see it yet. And I'll tell you why from a technical analysis standpoint. Here's the VIX. Okay, here's the VIX. I looked at the VIX and it hit me like a ton of bricks. The first thing we saw with the VIX is an impulsive move, wave A, an impulsive move. And then what I saw is an A and a B and a C. This happened during this consolidation. During this entire consolidation, right here, where was it? Right here. We had an A, the impulsive move, and during the consolidation, we had this A and a B and a C, okay, on the VXX. Now, last week was important. You know why? Because I noticed one thing. I noticed something very, very alarming. First of all, this one right here, this wave one, when I looked at it on the 60-minute chart, it looked like 1, 2, 3, 4, 5. So this is a start of a new impulsive move. Now, here's the other thing. Notice that wave 2 right here on VIX made a higher low. It made a higher low. Well, that's interesting. Why? Because that higher low came on an equal high, actually a higher high on the S&P. Okay? So the S&P makes a new high, but VIX makes a higher low. So that is a bearish divergence in my opinion. Higher high on the index, but a higher low on volatility. Okay? So volatility is not subsiding. In fact, we had a little bit of a reversal on Friday. It bounced off the 100-day moving average. Okay? Bounced off the 100-day moving average. So once we get above this 22 area, whatever the high was last week, when, you know, we had that panic move, not last Friday, the week before that. You know, once we get there, this will confirm that wave 3 has started. And I'm expecting a move from that 22 up to at least 27 or 28, followed by a little bit of a pullback and a final move to complete the ABC and hence the entire correction. And that's why, one of the reasons why I'm not here fishing yet. I'm not bottom fishing yet. The bottom is not in. If people want to tell me that, oh, hey, we have a double bottom, we do not have a double bottom. We don't have a double bottom. They need to look at the equal weighted S&P to see if there's a double bottom. They need to look at things like the transports, the banking index, the NASDAQ banking index, things that aren't always in the limelight. The things that people always look at are the things that are the least telling, in my opinion. So here's the NASDAQ banking index, okay? The NASDAQ banking index is actually lower, or has made a low that is below the May low. Here's the low, the May low, or early June low, whatever that was. The May-June low. We made a lower low. So what's happening here? A, B, C. Okay? So we're about to finish as far as the banks are concerned, because, you know, banks, the reason why banks are doing so badly, because when the curve is flat, the yield curve is flat, they cannot make money when they loan out to customers. They cannot make money on loans when the curve is flat, okay? Of course, banks make money in various different ways, but this is what the market is looking at, and they're saying, you know what? When the curve is flat, you know, credit kind of freezes. There's no way they can make money. Well, money's been flowing into the system or around. It's been flowing. There's money movement. People are borrowing, but not as much. And they're not, if whatever money they're loaning out, they're not making money on it. So that's important to take note of that. Without the financials, you think the market is going to get out of its own way? Is it going to start rallying again without the financials? Well, it's done everything without the financials, and it can take so much. You know, it's already done it and then failed miserably. You think it's going to do it again? Not until the rate cut is in place. When the rate cut is in place, what do you think is going to happen? The rates get cut, and now the curve begins to steepen, because now that inversion becomes undone, hopefully. But for it to happen, the rate cut will have to be more than 25 basis points. Believe me, it has to be at least 50, and I think it's going to happen. Okay, and then that's when the banks will bottom somewhere here near the prior lows, and then the B wave will be in, and the C wave will get underway to bring this entire bull run to an end. And let me tell you, the crab pattern depicted right here, this is a nasty pattern, because once it gets to its objective, boom, that's what's going to happen. It is notorious for its violent moves. So it's going to come back down to test that fourth wave. And at some point later on, believe it or not, it has the tendency to test extremes. So down the road, it will come back up here. But we're not interested in that now. What we're interested in are two things: time to bottom time the top and take advantage of these two moves. Okay? So again, I don't see a bottom here. Do you see a bottom? This is August. I don't have anything portending a reversal. Even when I look on the daily chart, I don't see it. In fact, on the daily chart, what I see is an N pattern, which is really a counter trend ABC. It's a flat. You know, I'm not going to show it right here, but, you know, we closed off the lows in August, off the lows, because of this pattern, ABC sideways. So a sideways move in ABC like this is a precursor to another move down. And I think we're going to come down, test this area, and then reverse course for good. Okay, so in essence, the correction that began in early May is still ongoing. Okay, that new high in July that I talked about, it's part of an expanded flat. So in April or early May, we reached a new high in the indices. We corrected and came up, okay, came up and in some cases exceeded the prior high. And now we're here, but we're headed here, in my opinion. And so this whole correction that began in late April, right here, okay, right here in late April, is an A and a B and a C. Okay, this B wave is a manifestation of a market that is impatient. It tried to break above the prior high. It looked like it succeeded for a minute, but it was a failed breakout. And that's exactly what an expanded flat is. That's why I'm looking for that C wave to retest the A wave. Okay? So I've talked about that before. Here's the transports. Let me tell you. Now, you had the A wave back in April, late April, early May. You had the May correction, a lower high, and now we actually made a new low in August. We're not done yet. I think we're going to come back down here. Okay, retest this area. And then the B wave will be done and we'll be ready for the C wave. Again, when that C wave is over, this entire bull run will be done with. And I don't know how far down, because this is when maybe this is a time to touch upon the yield curve inversion. Everybody's saying that, you know what, this time it's different. The reason why it's happening is because of all the inflows, the overseas inflows into our own treasuries, because they're seeking yield. They have negative yields in Europe and Asia and whatever, and they are seeking yield, and our instruments, our products are yielding better than anywhere. So that's why they're buying all these treasuries, and the prices of treasuries are going up, and therefore the yield is going down. And that's why the inversion is happening. That's why the 10-year is yielding less than the 2-year. Well, you know what? If all that money is flowing in, it's because there are problems in the world. Okay, they're not doing it because they choose to do it. They're doing it because they have to do it, because there are problems around the world. And so whatever the yield curve inversion is telling us, we don't know what it's really telling us, what the problem is. It's just telling us that there is a problem. And that problem is going to be known to us maybe within the next year, year and a half, whatever. The yield curve inversion is a leading indicator. When it happens, that's not when you get the recession. What it's trying to tell you is that you are in the ninth inning, buddy. Sure, the stock market can rally more, but it's going to rally more in an unwarranted fashion. In other words, it's going to be the last hurrah before you finally get trapped at the highs, just in time when the data is going to come out and say, you know what, we are in a recession, or recession has begun. And that's when everybody is going to rush to the exits. Okay? So don't believe all that crap about, oh, this time is different and the yield curve inversion, that signal is not what it used to be and all that. You know, listen, I'm not an economist, but I can put two and two together. I know about all the antics and the rhetoric of all these guys that come out wearing suits again and trying to claim that they know more than anyone else. And here's the other thing about fundamental analysis. It's just as bad as technical analysis. You can have 10 people doing technical analysis and they'll each give you a different viewpoint of what they think of the chart. Or you can get 10 fundamental people and they'll each give you a different fundamental story. So I don't, it all comes down to people and their viewpoints, whether they're looking at things from a technical perspective or a fundamental perspective. All right, let me go on here. Let me go on. Here's the stocks. Same story. 1, 2, 3, 4. You know what I think about semiconductors, the lifeblood of the modern day economy. We had an A wave here. We thought that the sell-off in May into early June was the B wave, but in fact what's happening is A, B, and a C, and that's where I'll put the B wave when it's over. So I think that the semis are super complacent right now, that they are near the highs, but they're going to come back down and retest the lows very soon. Only then will be ready to start the C wave to bring wave 5 to an end somewhere 1900 to 2000. Okay, close to 2000. Let's call it 1900 even. So let me tell you, do you think the semis are going to do this without a resolution to the trade war? I don't believe so, because they are the most susceptible. They're among everything, they're most susceptible to the trade war, you know, to non-resolution. So you have to have a resolution before you can see this kind of rally. And let me tell you, the stock market will never rally without semis. Never. Okay? So here's what happened. I think I did this on the 17th. I said, you know what? We have an A wave. We now have a B wave. I called that a B wave, but I was wrong because the B wave actually had more to go. But I'm not wrong about what to expect next. 1, 2, 3, 4, 5. It's going to happen. We're going to test the value area low for 2019 because we never came close to it. Okay? We rallied above the value area high. That was complacency, just like it was complacency right here. Okay? The moment we dropped below it, what do you think happened? We came all the way down to the value area low before rallying back up, double top, and this should prove to be an A and a B and a C, another flat, expanded flat formation. So we have an A, we have a B, and to those who trade harmonics, This is an A, B, C, D, or in Elliott wave speak, it's an A, B, and a C. And I went back to the chart today to see what's happened to that B wave. And actually what I noticed is that the B wave just printed this red candle where? At the value area high, again, that red line. And in the process, it retraced 50% of the A wave. And here's, look at this. A, B, and a C, followed by a flat, and then an A, and a B, and a C. A double zigzag. A double zigzag. Okay, what do you think is going to happen now? 1, 2, 3, 4, 5. Mark my words. Okay, and when we retest these lows, you can back up the truck, because by then I bet you that the moment we get here, the rate cuts will be in. There'd be some palpable, some real development, progress on the trade war and the trade deal, whatever that happens to be. Who knows? A lot of things might be resolved by then, or whatever happens, the market will be happy enough with it. Okay? Now, how about short-term considerations? Here's what I'm going to do next week. First of all, I did some trading actually Friday. I didn't post any of it. The moment the S&P reached 294, the moment it did it, I immediately sold 294, 295 credit call spreads. I didn't do much, and I needed to do it in a timely manner. And I've already told you guys that it's going to top at 294 anyways. So I did a little bit of that, nothing to write home about. And what I noticed is that we have, by the way, we have this, a double distribution. And there's a lot of backing and filling that needs to happen here, because this is a very low volume node. There's hardly any volume here. Because of what? Because of what? The gaps. The gapping open on Thursday. Okay? And the market is going to back and fill in a minute. And maybe, just maybe, this is the start of the final leg down in the stock market. Because remember what the VIX is telling us. The VIX is telling us that, let's go back for a minute here. Let's go back to the VXX. Where was it? Right here. What's the VIX telling us? It completed an ABC on the heels of this impulsive move. And no impulsive move occurs in a vacuum. Every impulsive move will be followed by another impulsive move after a partial move in the opposite direction. So we had this move already. I told you this internally is impulsive, so it must be wave 1. And therefore, this must be wave 2, because it was a higher low. It was a higher low last Friday, when in fact the S&P made a new recovery high. So this in and of itself is a bearish divergence, which means that wave 3 has probably started. Okay, wave 3 has probably started in the VIX. Okay, so if I'm right, what's going to happen with the S&P? Where's that chart? Right here. So I noticed that once we got up to that 294 area, I think it was 294.24 if I'm not correct, wrong. You might want to go back and see. But this is the weekly distribution, by the way. This is everything that happened through the week. Okay? This is the weekly distribution, bubble distribution. That's the auction, the weekly auction, market profile, volume profile, whatever you want to call it. So the first thing that happened on Friday is we got that A, B, and a C. Notice that? It was like, it might have been a bullish flag or a bull flag. It could have gone higher. It didn't, though. What we had is a partial move and then a sudden decline. Okay? Now, it stopped here because there was some support on the 60-minute chart. And then what happened is we got through the rest of the day, A, B, C into late afternoon, and then suddenly an A, a B, and a C. Now, I know the chart is too small, but I'm going to use straight lines right here. A, B, and a C, A, B, and a C, and then into the close, A, B, and a C. And notice the candle. Notice the candle, the ending candle on this 10-minute chart. It spiked up and closed near the low. So this tells me that if we are going to back and fill, there are two scenarios right here. Let's the scenario least desirable to us because we're looking for new lows to happen. So at a minimum, even if that's not going to happen, that ABC, which was then succeeded by this X wave, and then another impulsive move, and then a sideways move, for it to complete, it will have to come down and create a C wave so that you'll have an ABC, ABC, XABC. And then if it wants to go higher, fine. But I don't think that's going to happen. In fact, what's going to happen is because I use a different approach to Elliott wave, I use the harmonic Elliott wave. My wave 1 is an ABC. That X here is really a wave 2, and that ABC is wave 3. We'll see if that's the case or not, okay? We'll see if that's the case or not. So for us to know whether that's the case or not, and by the way, where is it going to stop? It's going to stop where the gap is, okay? And if that's the case, if we come down near that open gap, okay, all that gapping action, if we come down, almost fill the gap, then wave 3 will equal more or less 461.8% the size of wave 1. Now, if this is truly a 1, 2, 3, 4, 5, we should expect a fourth wave followed by a fifth wave down to the 287 area. And I'll tell you why that's the case. So the fourth wave should be around 290, 291. And the fifth wave will be around 287. This is last week's auction. That's the volume bar, the largest volume bar. Those two are the largest. And so we're filling this area with this action. Wave 1, wave 2, wave 3, wave 4, wave 5. Now, why would wave 4 be around 290 to 291? For that, you have to go to the daily chart. The daily chart. And what do you notice is at 290, 291, the 100-day moving average. What's at 287? The 2019 volume point of control. So what I'm trying to tell you is that we're going to complete wave 3 near 289, move up towards 290, and finish the fifth wave right here. Now, what happens next will depend on the nature of the move. But I think what will happen is once we get to 287, you'll be able to buy the market for at least a day. You'll be able to go long for at least a day. And based on the nature of this move, if we come back down and break below 287, this confirms that the move down was indeed a 5-wave, and now we're headed back down towards the lows, at least the 50-day moving average. I'm sorry, the 200-day moving average. But if this move is more than that, then we're probably headed all the way down to here. So it'll be A, B, and C somewhere here to bring this entire freaking correction to an end. Okay? So this is the plan. We're looking for continued move down towards 289 to fill the gap right here. You see that gap right here? Okay, so right here, move up towards the 100-day, move down towards 287. Right here, no matter which scenario is going to play out, it doesn't matter whether it's the bearish one or the bullish one. You'd be able to buy it near 287 for at least a day. You come back the next day, you can sell it at 290 if you want. So 287 to 290. And then you wait to see if there's a break of the low. If there's a break below the low of the previous day, you have to go short at that point because it's an unmistakable signal that we're headed back down towards the bottom of the range at least. And if that bottom of the range is breached, you can take profit right here and say, you know what, I'm not going to take advantage of this. If this is coming, I don't care. I can either wait for it and buy the market here, or when you come here, when you get to this point, you can start selling credit put spreads. Even though you're still up here, you can start selling credit put spreads at these strikes right here because I don't care. I can start with an initial position, buy some more right here, and if we go to an extreme, I'll buy some more. Or I'm sorry, sell credit put spreads. Sell the credit put spreads, the premium. Okay? Now, here's what's so interesting. Check this out. This is a rounding top. Do you know that in a defined uptrend, a rounding top is a bullish pattern? Because everybody thinks that a rounding top is a top, so it's going to, the market is going to fall by an amount equal to the height of the cup. Not the case. Actually, in a bullish trend, the market will rise by that amount. Okay? But you know what? I was thinking that once the market tops, this is going to be the left shoulder of the massive top in the market next year. This could be the left shoulder. We'll see. We'll see if that's the case or not. And I'm starting to wonder if there is a 3PDH pattern in play. I need to go back and see. It takes a lot of effort to determine that. The 3 peaks and a domed house. Anyone heard of this pattern? 3 peaks and a domed house, 3PDH. So I'm going to have to go back and see whether it fits in the scheme of things. This is peak 1, peak 2, and you know what? The 2018 high is peak 3. So 1, 2, and 3, those are the 3 peaks, okay? And the domed house will be here, something like this. This will be the dome. Believe it or not, the domed house is the head and shoulders, okay? And I'm going to have to do a video on this because it's such a precise pattern. You can basically count the number of days in between the peaks because there are guidelines for that. There's a guideline for when to expect the domed house, so on and so forth. So now that I'm looking at it, it never occurred to me that I should really take that into consideration. All right, so I want to keep moving on here for a second. We've been at it now for, how long have we been on? I started at around 9. It's past 10 o'clock. So we've been on for an hour. This is something we need to do every single week. The SPY options, you have 3 expiration dates per week. And the options have been dictating the correlation between the swing highs and lows with the open interest is amazing. I mean, you can put on some trades on Monday that expire by the end of the day, repeat that on Wednesday and then Friday. Let's look at the put-call ratio. This is not a market that's going to fall all the way down to here next week because put-call ratio is reflecting a little bit of fear. But what I think is going to happen next week is we'll get to 287 and bounce back. In other words, remember what I said? 1, 2, 3 down to 289, 4 up to 290, and 5 down to 287. So when the market snaps back, all these options on Friday, all of these puts, the red ones, will expire worthless. And all these guys betting on the upside, they're going to be disappointed as well. They're going to be disappointed. So if the move down to 287 happens on Wednesday, okay, let's say on Tuesday we'll get down to 2. Here's what I think. Let's say on Tuesday we get down to 289. That's Tuesday. And then snap back to 290 by the end of the day. And then come Wednesday, we open down at 287, meaning we've completed 1, 2, 3, 4, and 5. That's on Wednesday. You know what I would do on Wednesday? I'll sell put spreads, a put 287, 286 put spread. I'll sell it because we're going to snap back on Wednesday to at least wave 4, maybe even a little higher, okay? That would be the trade on Wednesday. Now, what happens Thursday, Friday? I don't know exactly. Maybe this, sideways, okay? Because if the market has started coming down, that's going to be an A and a B and a C, okay? That C wave isn't going to just happen like this. You're going to see a triangle, a sideways move that frustrates people. In fact, if we get this move and then we get that B wave, I'm probably not going to even look at the charts much for Thursday and Friday. Maybe Thursday I won't. But these are interesting times. I'm going to tell you why in a minute here. So this is for Wednesday. If you look at the open interest for Friday, That's even worse. Even though, look at these here. Those are way out there. I should not have included them. But even if you exclude these 70,000, the put-call ratio will probably be 2 to 1. Okay, so that's still a really sour mood. In other words, they're expecting they're expecting the market to go down. Let me tell you what, when retail expects the market to go down, you think the put riders, those who wrote these puts, do you think they want to lose? Okay, that's the theory at least. Now, if the market does go against them, they have the luxury of doing something called delta hedging. In other words, they sold you these puts, but they don't want to lose money. The moment the market moves in the wrong direction, they will short stock, because here they're counting on stocks not going down. But if the SPY now moves against them, their puts that they sold will go against them. And so for them to be delta neutral, it's called delta neutrality, they have to short stocks, so that when they short stock, the shorting of the stock will make them money to offset the loss in the puts. And when they short stocks, guess what? It feeds off itself and the market goes down in a big way. Now, when this happened this week, I don't know. It might happen this week. It might happen this week starting Friday. We'll see. Here's what I want to show you, though. Something interesting about, this is the 13th, by the way. On the 13th, meaning the week after that, look at the put-call ratio. Neutral. It's neutral. Isn't that interesting? The number of puts and calls is almost equal. This, the week of the 13th, is when I would expect bad things to happen. Okay? Because these guys who bought these might end up being right after all, even though their puts right now are losing premium big time. Well, those might have been spreads. They bought these, sold these, or bought these, sold these, who knows? Or bought these and sold here and here, spreads, in other words. You don't know, okay? But these might end up being right. You know what? You think these guys are going to be right? I don't know. Is the market ready on the 13th of September to break through resistance and approach 3,000 based on what? Because Apple is about to announce a new series of iPhones? Come on. In fact, talking about Apple, let's look at this right now. Let's look at Apple. You know something? For the first time in 5 weeks, it closed above this trend line. And I started wondering, I said, this is a bullish development. That's a bullish development. Well, we had a bearish harami right here. You see that? That red bar inside the body of the green bar. Did we go down? No, we rallied. We rallied. So is this a bullish development? And we have a bullish harami here. Why is it closing above the trend line? So before I give you that answer, I want you to know that I fully expect a move down to the May lows. Okay? I'm using the wrong tool right here. I should use a circle. Those are the May lows. I'm looking for a move down to here. And then a rally, 1, 2, 3, 4, and 5 to 260. Okay, 260, 261 will be the top for Apple before it gets cut in half again. Okay. But first of all, look at this red bar right here. And did you guys know that, I never mentioned that, there was a 13, a TD sequential sell 13 on the weekly chart, okay? And they trapped everybody. They trapped everybody when they released earnings. This 13, by the way, this TD sequential 13, if someone were to short Apple upon its occurrence, or even on that move that we got on the day after earnings, anybody who shorted, their stop would have been right here at 231.51. Why? Teach you a little bit about DeMark here. First of all, you start out with a black series of bars, 1, 2, 3, 4, the ones labeled in black. You need 9 consecutive bars where each bar closes above the closing price of 4 bars earlier. So everyone labeled in black, 1 through 9, the close of that bar happens to be higher than the closing price 4 bars earlier. That's called the TD sell setup. In other words, we're setting up for a sell down the road. That's what it means. Doesn't mean that you're ready to sell. No. It's a count, and when certain conditions occur, that sell signal is going to occur. So then when you have a minimum of 9 bars, 9 black bars, the black count begins. I'm sorry, the blue count begins. Forget the red one right now. It's not, for all intents and purposes, we don't need it right now. We're only interested in the blue one. The blue one is called TD sequential 13 or TD sequential sell 13. That's what the blue count is. Okay, TD sequential. So once the 9 is in, then you start by counting in blue. What is the condition for the blue count? The closing price of a blue bar must be higher than the high 2 bars earlier. So look at the closing price of bar number 1, the blue one. Okay? If you look at the count, at the closing price here, it's higher than the high of 2 bars earlier. Okay. Same thing with this. The closing price is higher than the high 2 bars earlier. Now, 1, 2, 3, 4, 5, 6, 7. This one was not labeled in yellow. Why? Because the closing price was lower than the high of the bar, or the high of 2 bars earlier. Same thing with this one and this one, because we were in a downtrend. But then we started rising again, and this green bar had a closing price higher than the high 2 bars earlier. The 9th one, bar number 9, closing price higher than the high 2 bars earlier, so on and so forth. And then we got to a 13. When you get to a 13, you better be on the lookout. Now, you could have taken a short right here, okay? I'm sure a lot of people took a short, but you know what? They got them out of their shorts, unless they had nerves of steel. Let me tell you why. Because if they shorted the market when that 13 occurred, their stop would have been here. Why? Is it because it's near the prior high? Why is it 231.51? The rule is that within all the 13 bars labeled in blue, the bar that made the highest high, which is here, and it could have been a bar not labeled as long as it's within the 1 through 13. You know, it might have been this one. This one might have spiked like this and closed here. It still would not have been labeled in blue. Still, we could have had a volatile day driven by some news, and we could have made a crazy new high like we did here. But it doesn't matter. From 1 through 13, you look at the highest high, and the bar that made the highest high, you take the length of that bar, the height of the bar from the low to the high, you multiply it by 2, and you get here. And that's your stop. That's your stop. Well, we never got there. And so those guys who shorted were pretty happy. So the right move, if I had been very attentive, the right move on the day after earnings would have been the moment, you know, it did what it did, especially when we saw the day ending in a red bar like this. Actually, the whole week, but you know what kind of day we had. I would have immediately shorted credit spreads, September spreads, above 231. But that didn't happen because if you remember, I was looking forward to continue on up to the prior highs. That would have been the conventional wisdom. But I've learned lessons, a lot of lessons actually, by studying this chart over the last few days, because I've been obsessed with what happened. There was a lot of things to learn about market behavior from this chart. So that's why I do believe that what we have here is exactly what we have on the other charts, A, B, and a C, an expanded flat. An expanded flat could be a running flat if that C wave, by the way, does not have to exceed the A wave. It could end slightly higher than A, and that's fine. That would be a running flat. And when the market bottoms 1, 2, 3, 4, 5 into next year, and then the mother of all shorts after that, okay, would be coming back down here. All right. I have more, though, about Apple. This is the monthly chart. What we were talking about is the weekly chart. On the monthly chart, and again, I was too complacent. I was actually away for much of August, if you recall. We had a sequential count on the monthly, just like we had a sequential on a weekly. The monthly is even more strategic, more significant, because the time frame tells you what? Expect a cycle high at some point down the road. Now, I'm not going to short it right now because the monthly said I have a 13. A combo 13 is similar to sequential. It's the different way to count up to 13 bars. Okay, a sequential is more popular than the combo, but they're both sell signal. Guess what? Guess what? Mind-blowing, okay? Mind-blowing. When I took that red bar, 13, and multiplied it by 2, I got a stop loss. It's called TD risk, by the way. TD risk. What does that mean? It means that if you short Apple upon the occurrence of that 13, your risk is here. In other words, you might not be proven right until this stock reaches here and then turns back down the road. Okay, now I'm not ready to short Apple just because I have a 13 on the monthly chart. For me to short Apple, I need to see a topping formation of some sort, or a double top, a head and shoulders. I don't see anything here yet, okay? And I have a sequential. Now the sequential also have the same stop. One is 260.43, the other one is 260.85. Now, for the combo, I took this bar because it's the bar that has the highest high within the red count. And then I said, okay, from the blue count 1 through 13, which bar has the highest high? It's this one right here. So I took this one from low to high, multiplied it by 2, and I got 260. It's like there's an invisible hand that plays these games, and it's up to you to put the puzzle pieces together. So I took note of it, and I said, you know what? Next year sometime, when they report earnings, or whenever they get to that point, guess what? We should expect the same thing that happened in late July, early August, this thing right here, the same exact thing to happen also up here. Whatever happened in August of this year, the same thing should happen when we get up here later on next year. So that's something to look forward to. Short-term considerations for Apple. Short-term considerations. Because what happens next year, we'll leave that to next year. Look, let me tell you again, unless I'm crazy, what I saw here is a 1, a 2, and a 3, where 3 equals 161.8%, the size of wave 1, a shallow wave 4, because I had a deep wave 2 here, so this is called alternation. Whenever 1 is deep, the other one will be shallow. If 2 was the shallow one, 4 would have been the deep one, up to 50%. Okay? 1, 2, 3, 4, 5, even the fifth wave hit the textbook 61.8%, meaning the total length from here to the third wave, okay? This distance from the top of wave 4 to the bottom of wave 5, this here, this distance from 4 to 5 equals 61.8% the distance from top of 1 to bottom of 3. That's also textbook. So this to me is an impulsive wave A, followed by a corrective wave B, followed by an impulsive wave C. We might have seen wave 1 last week. Well, why do I say that? Because the S&P is back, not to its high. Did it actually make a new high? I'm not sure if it made a marginal new high. It's back to 294. And you're telling me that Apple this week couldn't get past 210? It didn't get back to the previous high that we saw. When did we see that? 214. When did that happen? We got right here. Was that 214? Yeah, that was it. That was the week before we got the order from the president for all companies to look for alternatives, and China came back and said they're going to retaliate, whatever. So that was the day before when we got to 214. Okay. So the S&P is back to the recovery high, but by the way, this chart was done on the 17th also, when I thought that wave 2 was in place, but it wasn't, because we did this. We came down here and then we came back up here. So we ended up with an ABC. So assuming this was truly a 1, 2, 3, 4, 5, assuming that was a 1, 2, 3, 4, 5, and now this is an ABC, isn't it time for wave 3 to start? Isn't it time for wave 3 to start? And so this was on the 17th, okay? So the chart does not reflect what's happened over the last 2 weeks. I'm going to show you what happened. So wave 2 occurred a little higher, if I'm right, and it did this, okay? So let's switch over to the next chart. Here, that's what happened, okay? This is what we got. That was the 214 high that I'm talking about. In other words, that was 214 right here, okay? That right here, 214, and that B wave right here, or whatever I labeled B, by the way. So we had the A, which was unarguably impulsive, 1, 2, 3, 4, 5. And then I got A, B, C, let me see. I'm sorry. Where was it? B, C, X. Oh, okay. On the 17th, let me tell you what happened. Here's what happened. 1, 2, 3. That's ABC. X, A, B, and then we got to 214. Okay, so this B wave right here, whatever I thought was a B wave, is really here. Okay, so that wasn't 1, 2, 3, 4, 5. Scratch that. That was an X wave. So A, B, C, X, A, B, it's a B wave, and C. And that C is wave B. And let me clean it up, okay? Let me clean it up so that you don't get confused. I'm going to use blue. I'm going to say A. Here we go. A, B, C, and then we had the X wave, and then we got, that was wrong, that was premature. A, B, and then because this chart was published on the 17th, I didn't account for, I'm not showing, I thought that was wave 2. Actually, what happened is this, up to 214, and then we got our C wave. Remember when I said there's a terminal diagonal at the top of the C wave, and then we got that panic move 2 Fridays ago? Where did we get it? Down here, right? And this week, what have we recovered to? Here. So this might end up, believe it or not, being, and I'm going to show it on the next chart, left shoulder, head, and last week's recovery up to 210 was the right shoulder. So 1, 2, 3, 4, 5, ABC, X, A, B, C. The C wave is the head. The A here is the left shoulder. And last week's high was wave 2. This could be 1, 2, and 3 has begun. Okay. So let's switch over to the latest chart. Here we go. That was the last ABC. Oh, remember ABC, we had a terminal diagonal, and we have an impulsive move. Now, what happened last week? A, B, and a C. Okay? So, left shoulder, head, and this ABC, even though we could continue on a little further for a few days until they release the phone. Okay, and I count on that. I'm not looking for a breakdown right here, and I'll tell you why. It all comes down to options. But I truly believe that the left shoulder is forming. And why does it need time to form? For two reasons. For two reasons. First of all, on September 10th, what do you have? That much anticipated release of the new iPhone. Great. You guys know what happens every time they release a new product. Not always, but a lot of times. So here's what I'm looking at. This is the daily now. We talked about the monthly. We talked about the weekly, and I'm showing 13s across the board. TD sequential 13s on monthly, on weekly, and now on daily. Okay? In fact, if you look at the daily, we had a combo 13, a red 13. This was invalidated, that blue one. That's from a previous count, so ignore this one. Here's what happened. On the day that they released earnings, or the day after they released earnings, we got a red 13, okay? We also got 8 and 9. That 9, by the way, occurred on Wednesday or Thursday. I think they reported on a Tuesday. You guys can correct me. I don't know when. Whenever they did. This was earning the day after earnings. That was the day after. So we got the 9. Now, after the 9 begins, you should start counting in blue. All right? So, 1, 2, 3, 4, 5, 6 was here, 7, 8, right? 9, that was Thursday. 10 was Friday. We're missing 11, 12, and 13. These bars, 11, 12, and 13, remember the blue count, they don't have to be consecutive. The bar labeled in blue, only the ones in black. The bars labeled in blue. So we have from now until September 10th to print 11, 12, and 13. And so until then, remember what I said on Friday, that Apple will be range bound between 206, which is the 50-day moving average, and 210 right here. So I'm telling you that next week we'll be doing something like this. And when bar 13 prints, mark my words, 13 could be September 10th. Bar number 13 must make an intraday high of at least 210.36. In other words, it needs to come up and touch it. Why? Because there's a rule that bar number 13 must make an intraday high that is higher or equal to the closing price of bar number 8. Okay? So we're going to hang out here for a while, range bound, and when bar number 13 is in place, it will spike up to 210.36, okay, before turning back down. So the right shoulder is still forming. Left shoulder, head, and the right shoulder will do something like that. And then when we break below this neckline, we're headed down to complete wave C in the 170s, I believe, in the 170s. Okay. So everything to me indicates that we're not near they keep saying the markets are resilient. They are near their highs. Well, they're near their highs because they are hoping for this and hoping for that, and they're waiting and seeing, not because of anything else, nothing. Or despite all that's going on in the world, well, that's how complacency happens, by starting to believe that the market, has an unbreakable spine, and no matter what happens in the world, the market can withstand all these hits. Forget it. Forget it. The market is a treacherous mechanism, and that's what it's waiting on. It's waiting on Apple. What happened in early August? It was waiting on Apple. The moment Apple reported, what happened? The market took a hit like you wouldn't believe. And then it was exacerbated the next day by the Fed only cutting 25 basis points. Same thing here. We're waiting on Apple for the next leg to begin. Now, last but not least, look at the options for this week's expiration. Complacency like you wouldn't believe. There are more calls than there are puts. Look at these crazy people. Betting on 212, is that 212 or 215? Let me see. 212.50. Where's 212.50? Right here. That's the highest number of calls on this chart. And I'm going to tell you why this is dumb as anything in a minute. Okay. Now, look at the week after, 13th. 13th. Again. I mean, are these the same chart? No, they're not, but they're almost identical. The distribution is almost identical for this week and next week. The biggest number of calls is the 212.50 strike, which blows my mind. And actually, in this case, it's 215. Is it 215 or 212? 210. This might be 210, actually. This is 210. Yeah, that's 210 right here. 5,832. Okay. So why do I think, and again, a put call ratio below 1? I mean, what is Apple, a miracle worker? They're about to be hit. I mean, go to Bloomberg right now. There's an article about how the tariffs are going to impact Apple in a big way. Okay, starting September 1st, by the way, because even though tariffs for iPhone and mobile devices, whatever, have been deferred until December, there are plenty of products Apple makes, plenty of products that Apple makes that will start being impacted tomorrow, okay? Tomorrow. So, okay, so they can be complacent all they want. Let me tell you why 210, 212 is a crazy strike to be betting on. In fact, I don't have that chart. I need to use a live chart for that. Let me bring up the live chart for Apple. Here we go. Here's Apple's daily. Okay, here's Apple's daily. And here's our Here's an interesting line right here. The one connecting the two most recent highs. Okay, so they're looking at this as a triangle ready to break out. Okay, they're looking at this as a triangle ready to break out, when in fact, I'm looking inside the triangle and I'm seeing a head and shoulders. Okay, so two ways to look at things. One guy is seeing a triangle, when in fact I'm looking at it as a triangle that's going to break down because of the head and shoulders and because of this impulsive move, A, B, and a C down to the value area low. Okay, you see where we are right now? This is the value area low for 2019. This is the value area high. And the black line right here, that's the 205 area, more or less. That's the volume point of control. We tried to break below it last week, and I thought this is the start. Wasn't the case, because the left shoulder wasn't done yet. Okay, so again, the value area high is here. What do you think it is? 212.50-ish. And they're putting their strikes right here as if it's going to break out again. Okay? So they're betting on that. If it's going to break out, buy something higher because it'll be a legitimate breakout. Why would you buy it right here? Go ahead, that's fine if they want to do that. That's more power to them. Okay, so they're being very complacent because they're looking for this trend line, this supply line to be overcome, to be broken through, just because new iPhones are going to be released. Pretty dumb, if you ask me. So who knows? Knowing what Apple is, we might come up and touch this line near 210 again, 211 or whatever that is. We could end up with equal shoulders, but let me tell you, if we don't get an equal shoulder, that's perfectly fine. A lower right shoulder relative to the left one is an even more potent head and shoulders. So assuming this is a head and shoulders, the most important thing that you want is a break of two things. Let me draw the neckline. Jesus, can I get a good pen here? Let me draw the neckline. This is the left armpit. This is the right armpit. And let me extend it out. Choose yellow. Here's our neckline. Here's what would be significant. A break of the volume point of control and the neckline at once. Okay, at some point. We break below this black line. Okay, this black line. You want me to put it in black so I wouldn't confuse you? A break of this black line and this neckline means that we're headed lower all the way down here to start with, a little bounce and continuation towards 270. In fact, I'm going to do the math here with you and see, because I haven't done it yet, because I'm looking for a 5-wave move, right? So what is, by the way, the VPOC on this chart? Let me see. What's it at? 202.81, 202.80. Okay, so that's what we need to see breached. 202.80. Okay. By the way, none of this is so precise that you have to cry over spilled milk. 202.80, 202.70, 202.56. Look, you see um, a very discernible break, a very clear cut break below the black line. Well, you don't have the black line. I have it, so I'll be publishing it. But if you do have charts and you draw the same neckline, once we drop below, let's say 202.50 or 202, it's done. It's done after that. That's it. It loses that 50-day moving average, which it did here, by the way. That was a nice little trick on their part. Okay? So let's say that this was wave one and this is wave two. Where would wave three be? Because that's a move we want to take advantage of. So this is one, this is two, and wave three, my friends, if it wants to reach 1.618 to 1.764, or the 50-day moving average more or less, because you know when panic sets in, you're not going to hit a target right on its head. You're going to come down here, overshoot it a little bit, and then snap back temporarily. Here we go again. So good with my charts. Okay, so 1, 2, 1, 2, 3 down to the area of the moving average, the 200-day, a slight snapback, and 5 down to here. That's what's going to happen. That's what I believe is going to happen. So you have a deep wave 2 right now. See what kind of wave 2 we got. And I can't tell yet if it's over or not, even though the recovery off the 2 weeks ago, the panic Friday low is an A and a B and a C. There's a possibility we're done with wave 2, wave 1. So if that's right, if I'm right about that, then wave 3 should start immediately. And so wave 2 retraced almost 70, I would say 70% of wave 1, and there's a good chance next week we'll hit 212. Who knows? It's possible, not 212, 211, meaning we'll touch that line. There's a possibility. Okay, we might do that, you know when? On bar number 13, or we might not. So make a long story short, let's assume that wave 2 is done. Okay, I'm going to assume that wave 2 is done, and now we're ready for wave 3. So our wave 3 would be somewhere in the neighborhood of 1.618 to 1.764. And our wave 2 was deep. It was above 61.8, below 78.6, somewhere right here, which means that wave 4 will be shallow. So wave 4 will probably be something like 23.6% of wave 3. What does that mean? From here down to here, let's say, we'll be retesting 191, that area. You know what we'll be retesting? The prior low right here. That'll be wave 4 because we broke below it. 1, 2, 3, test the prior swing low. That would be 4, and then 5. Okay? That's how I see it playing out. In fact, I'm looking for wave 5 to be 61.8%, the total distance from 1 through 3. And let me do the math here a little bit and see if this works out. From the top of 1 to the bottom of 3, roughly by the 200-day moving average, up to 23.6%. And guess what? Guess what? This is what I've always been looking for, right? About 173, the value area low. 61.8% is the textbook target for the fifth wave. 1, 2, 3, 4, 5. Does it sound too good to be true? We'll find out very soon if I'm full of it or I'm predicting accurately, or my predictions will come to be true. We'll find out. We'll find out. Okay? That's all I got for you. That's why I'm so confident, not so confident. I mean, yes, I am confident. I'm not going to lie. I'm pretty confident in that we're not done yet with the correction, that there's one more panic in the market. And therefore, a very, very good opportunity to profit from it when it happens, and profit even more when the market finally bottoms. Because imagine if we had played any of those swings correctly and in a timely fashion. It would have been a thing of beauty. But it certainly served us well to look back and study what has happened, analyze it, make sense of it, and then put together an actual plan to trade based on what we've learned so far. Any questions? That is all I got, actually. And hopefully this will, come to fruition and not prove to be a waste of time on a Saturday evening. All right, guys. Todd, Lee, Jung, Mike. Guys, thank you for indulging me here, because it's always, I'd rather do this in the presence of people. I cannot record it on my own and be satisfied with it. I'd like to be talking to people or addressing people during the presentation. Knowing that you guys are here will make it a lot more fun and more effective for me. I don't want it to be rehearsed. I want it to be spontaneous. So any questions at all? All right. Have a great weekend, and I'll do my best to be available next week. I think Tuesday should be okay, but as I said, the moment we start getting rain, a lot of rain and wind in Florida, whether we get hit by the storm or we just get shrapnels, of course we're going to get a lot of winds and rain. But down here in Florida, man, I don't know what it is. The moment a bird chirps, power lines, the power goes out. It's just crazy. It's like a third world country. All right, I will be in touch soon. Thank you guys very much for attending this evening, and be safe.